Have you ever wondered how you can earn regular income from your investments? Well, one way is through dividend investing. Dividends are essentially a portion of a company's profits that are distributed to shareholders. Think of it as your share of the company's earnings being given back to you. It's like getting a slice of the business's success pie. Now, why would investors be interested in dividends? The appeal lies in the potential for regular income. Unlike capital gains, which depend on the market price of your stock going up, dividends can provide a steady stream of income, regardless of how the stock price is performing. It's like having a reliable paycheck but from your investments. But wait, it's not as easy as just picking a stock and waiting for the dividends to roll in. There's more to it than that. So, in essence, dividends can offer an appealing way to generate income, but it's not as simple as it sounds. Let's delve deeper. You might ask, what exactly is a dividend yield? Well, it's not as complicated as it sounds. Let's break it down. In the simplest terms, a dividend yield is a financial ratio that indicates how much a company pays out in dividends each year relative to its stock's current market price. It's usually expressed as a percentage. Imagine dividend yield as a way to gauge the immediate return on each dollar you invest into a company. If a stock priced at $100 pays out $5 in dividends over a year, the dividend yield would be 5%. That means for every $100 invested, you'd receive $5 back annually in dividends. But don't be too quick to jump at the stock with the highest dividend yield. A higher yield isn't always better. That's right, it may seem counterintuitive, but a high yield could be a red flag. It could signal that the company is in financial distress, or that the dividend may not be sustainable in the long run. So, while dividend yield is an important factor, it's crucial to look at the bigger picture. Consider the overall financial health of the company and its capacity to sustain these dividends over time. Remember, a high dividend yield is attractive, but it's equally important to ensure that the company can sustain these dividends. So why should you consider dividend yield stocks? Are there any benefits? Well, let's break it down. Investing in dividend yield stocks can offer several key advantages. First, they provide a steady stream of income. Unlike some investments that only yield returns when you sell, dividend stocks pay out regularly, often quarterly. This is particularly appealing for those seeking a consistent income stream, like retirees. Secondly, dividend yield stocks can contribute to long-term wealth accumulation. This is because dividends can be reinvested to purchase more shares, thereby compounding your investment over time. This compounding effect can significantly boost your total return in the long run. But there's more. Dividend yield stocks offer a cushion against market volatility. While the market price of a stock may fluctuate, companies with a history of paying dividends tend to continue doing so, even during market downturns. This means that even if your stock's price dips, you could still be receiving dividends, providing some level of return and potentially offsetting losses. Now, it's essential to remember that dividends are just one aspect of your total return on investment. While a high dividend yield can be attractive, it should never be the sole factor in choosing a stock. Always consider the company's overall financial health and growth prospects. So, dividend yield stocks can provide both immediate income and potential for long-term growth, a dual advantage that few other investments offer. Did you know there are different types of dividend-paying stocks? Let's take a tour of the dividend yield stock universe. First up, we have the blue chip stocks. These are shares in large, well-established and financially stable companies with a history of reliable and even increasing dividends. Think of companies that have stood the test of time, weathered various economic storms, and are still standing strong. Next, we venture into the realm of the dividend aristocrats. These elite stocks have a proven track record of increasing their dividends for at least 25 consecutive years. They're the royalty of the dividend world, providing a steady and growing income stream for their loyal subjects, the investors. Finally, we arrive at high-yield dividend stocks. These stocks offer significantly higher dividend yields compared to the average stock. But remember, with great returns come greater risks. These stocks are often from companies with uncertain futures or in sectors under stress. They can provide a hefty income stream, but they also carry a higher risk of cutting their dividends. Each of these types of dividend yield stocks has its own characteristics and considerations. Blue chip stocks are often seen as safe havens. Dividend aristocrats offer stability and growth, while high-yield dividend stocks can bring potential for high returns, albeit with higher risk. Choosing the right type of dividend stock is essential to match your investment goals and risk tolerance. Remember, investing is not a one-size-fits-all game. It's about finding the right fit for you. Now that we know the types, how do we select the right dividend stocks? You might wonder. Well, the first thing to look for is a history of consistent dividend payments. A company with a long-standing record of paying dividends is more likely to continue doing so in the future. Next, consider the company's payout ratio. This is the proportion of earnings a company pays out as dividends. A sustainable payout ratio typically falls between 30 and 60%. If it's too high, the company might be stretching itself thin, and if it's too low, they might not be sharing enough profits with shareholders. Another crucial criterion is a track record of earnings growth. Companies that steadily increase earnings over time are more likely to raise their dividends as well, leading to a higher yield for you, the investor. Now remember, a company's financial health and stability are the bedrock of reliable dividend stocks. Look at factors like revenue, net income, free cash flow, and debt levels. Also consider the company's competitiveness in its industry, its management team, and its future growth prospects. Finally, don't forget to diversify your portfolio. Investing in different sectors can protect you from industry-specific risks and market volatility. While dividends can be a great source of income, always remember to thoroughly research before making any investment decisions. Investing wisely is all about being informed, patient, and strategic. Happy investing.